You're standing at an ATM, and it spits out an extra $100 bill by mistake. Free money. What do? Now imagine something different. You pick up an extra Saturday shift, and when your paycheck comes in, there's an extra $100 for doing overtime. Same amount of money, same wallet, same person. But here's the weird part. You probably won't treat those $200 bills the same. Not even close. And by the end of this video, you'll probably catch yourself doing it too. Maybe for the first time. The person who first brought this idea into the spotlight was Richard Thaler, the economist who later won a Nobel Prize for showing just how irrational our financial decisions can be. Back in the early 1980s, he ran a simple thought experiment. He asked people to imagine receiving the same amount of money in two different ways, one as a reward they'd earned, the other as cash they simply found. The amount never changed. Their reaction did.
People were much more willing to blow the found money on something fun, a night out, drinks, an impulse purchase, than money they'd worked for. Thaler called this mental accounting. Your brain doesn't treat every dollar equally. Instead, it groups money into different mental categories, and those labels quietly shape how you spend it. One account says, "Be careful with this." Another says, "This is extra. It doesn't really count." Same dollars, completely different rules. You can see this in real life every year during tax season. Roughly 3 out of every 4 American tax filers receive a refund, and the average refund is around $3,000. Economically, that isn't free money. It's your own money that you overpaid in taxes throughout the year, finally being returned. In theory, it should feel exactly like part of your paycheck. It should be spent the same way too. But it isn't. Studies tracking spending around tax refunds find the same pattern. When those refunds arrive, discretionary spending jumps. People are more likely to buy electronics, book vacations, or finally splurge on something they've wanted for a while. Yet if that exact same $3,000 had been spread across 52 weekly paychecks, most of it would have quietly disappeared into rent, groceries, utility bills, and everything else that keeps life running. Same money, different mental folder, completely different decisions.
And tax refunds are just the beginning. Casinos have been taking advantage of this effect for decades, long before psychologists gave it a name. When gamblers are playing with winnings instead of the money they brought in, they tend to take bigger risks, make larger bets, and become much less cautious. Researchers call this the house money effect, but it's really just mental accounting in disguise. The moment you win $50, part of your brain quietly stops treating it like your own money. It becomes casino money, play money, money that somehow doesn't feel as real as the cash you'd use to pay your rent, even though the cashier will happily exchange it for rent money at exactly a 1-to-1 rate. That's the same logic behind the extra $100 from the ATM. A bill that you think wasn't supposed to be there naturally gets filed into a completely different mental account than $100 you earned by working overtime, even though both bills can pay the same electric bill, buy the same groceries, or cover the same rent. Now take that idea to its extreme, and you end up with one of the strangest financial patterns researchers have ever documented. Lottery winners going broke. Studies tracking major lottery winners have found that a significant number end up filing for bankruptcy within just a few years of winning, sometimes even faster than people who never received a windfall at all. On the surface, that seems impossible. Someone who suddenly receives millions of dollars should have every reason to be more careful, not less. But mental accounting offers a surprisingly powerful explanation. A windfall that large gets pushed so deep into the found money category that it almost stops feeling like real money altogether.
Researchers who have interviewed former lottery winners often hear the same story. The money feels different. It feels like house money on a much bigger scale. The exact same casino effect, just with a few more zeros attached. Suddenly, expensive purchases don't seem that expensive. Risky investments don't seem that risky. Lending money to friends or family doesn't seem like a big deal. Every decision gets filtered through the quiet assumption that this doesn't really count, until it's all gone, and someone is standing in bankruptcy court trying to explain how millions of dollars disappeared in less than 5 years.
The lesson isn't really about lottery winners. It's that making the windfall bigger doesn't fix the bias. It makes it stronger. A bigger found money folder simply creates a bigger blind spot. And mental accounting doesn't stop with individuals. It quietly shapes the way couples think and argue about money too. Research on household finances shows that when couples mentally divide income into my money and your money, even if everything ultimately belongs to the household, they often become far more protective of the money they personally earned. A spouse's income or shared windfalls like a tax refund can feel more negotiable, easier to spend, and less important to protect.
Nothing about the dollars has changed. The only thing that's different is whose name your brain attached to them. That's one reason so many couples argue over money they technically own together. The disagreement usually isn't about the balance in the account. It's about the mental category each person placed that money into long before the conversation ever began. The same distortion even shows up during salary negotiations. Ask for a $1,000 raise spread across 26 paychecks, and many hiring managers barely notice. It blends into payroll as just another ongoing expense. Ask for that exact same $1,000 as a signing bonus, though, and suddenly it feels like a much bigger decision, even though the total cost to the company is identical. The lump sum triggers the same mental response as a windfall for the employer paying it and the employee receiving it. So why does any of this matter beyond being an interesting aspect of human psychology? Because this one mental shortcut quietly influences thousands of dollars worth of decisions every single year. And most of the time, you don't even realize it's happening. Think about year-end bonuses. A bonus is earned income in every meaningful sense. You worked for it, sometimes harder than for any other money you made that year. But because it arrives separately from your normal paycheck in one lump sum, your brain often files it closer to windfall than salary. That's why bonus money so often disappears into vacations, new gadgets, or lifestyle upgrades much faster than the same amount would if it had been spread across your regular paychecks. The same thing happens with credit card rewards, cashback, or rebate checks. It's all real money. It ends up sitting in the exact same bank account as everything else you own. Yet spending data consistently shows people treat it more casually and spend it more quickly than an equivalent amount that arrived through a normal paycheck. Even inheritance money follows the same pattern. Research on financial windfalls has repeatedly found that people tend to save a smaller percentage of inherited money than they save from their regular income, even though inheritances are often much larger. Logically, a bigger amount should make people more cautious. In reality, the label often matters more than the amount. The label wins. Financial advisors who understand mental accounting often recommend flipping this tendency on its head.
Their advice is surprisingly simple. Before deciding what to do with any money, pretend it all arrived the exact same way. No special folder for tax refunds, no special folder for bonuses, no special folder for cashback, rebate checks, unexpected ATM mistakes, or even life-changing windfalls. Just one account, one set of rules, one version of you making the decision, instead of a different version depending on where the money came from. That one mental shift, collapsing all those separate folders into a single account, is one of the simplest and least talked about ways to narrow the gap between how much you earn and how much you actually keep. So let's go back to that extra $100 bill from the ATM. What did you subconsciously want to do with it? If your first thought was to spend it a little more freely than you would $100 from your paycheck, then you just watched mental accounting play out inside your own mind before you even knew there was a name for it. The money was never the problem. The label was. And now that you can see the label, you get to decide whether it deserves to make your decisions for you.